Welcome back to the deep dive. Okay, if you paid any attention at all to the financial headlines this week, you know the gold market delivered a serious gut punch.
Yeah, it was pretty rough.
We saw incredible volatility and specifically some sharp pressure that sent mining stocks tumbling. So we've dug into a stack of research focused entirely on how to interpret this chaos.
Right. Not just chaos, but maybe opportunity.
Exactly, seeing it not as just risk, but as a deep strategic opportunity.
That's right. Our mission today is, well, to cut through the noise of the last 48 hours or so. We need to understand that sudden cool down in the gold price. And really critically, identify the specific companies where sophisticated institutional investors, what this research calls big money, where they might actually be scaling up their positions now.
Okay.
We are laser focused on finding those gold names where the fundamental story, the core reasons for owning them, remain intact regardless of these temporary price drops.
Okay, let's start with the trauma then. The data point that shocked everyone. Tuesday, October 21st, 2025. The shiny metal fell a staggering 6.43%.
Wow. Yeah, 6.43%. That's its largest single decline in, what, over a decade?
Over a decade, yeah.
That kind of single-day drop is, well, it's enough to make almost any investor panic, right?
Absolutely.
But here's the crucial perspective, the necessary context. This is like the aha moment you need to hold on to immediately. Even after that significant sharp decline, the main gold ETF, GLD, SPDR Gold Shares, it's still up a colossal 55.8% year-to-date in 2025.
55.8%. Still.
Still. And if you zoom in just on October, this month alone, even factoring in that Tuesday plunge, gold prices are still up 6.1% for the month.
So we're talking about volatility that is, it's highly relative. It feels catastrophic because of that big percentage drop in one day.
Right, big headline number.
But it's occurring against a backdrop of truly phenomenal performance that came before it. A 55.8% gain in just over 10 months, that's historically massive.
It really is.
So what underlying economic forces fueled that huge rally through 2025 in the first place?
Yeah, the sources are pretty crystal clear on this. You can trace this surge back to, three persistent macro forces that haven't really gone away.
Okay, what are they?
First, rapidly rising government deficits in major economies. That inherently weakens the appeal of fiat currency.
Right, makes gold look better.
Exactly. Second, sticky, persistent inflation. It just keeps the demand for gold as a hedge pretty high.
Still dealing with that.
We are. And third, you've got persistent high-volume support from central banks globally. They're actively diversifying their reserves, buying gold. That whole cocktail created the surge earlier this year.
Okay, so if the underlying drivers are still in place, deficits are still rising, inflation's still sticky, then the investment environment, you'd think, should still be supportive.
Logically, yes.
Which leads to the central investment logic we need to explore then. Why focus on the miners right now, especially when they just saw that sharp, painful drop? Is buying the dip here more than just, wishful thinking?
It absolutely is, or at least that's what the research suggests. And this is where the sophistication of institutional buying comes in.
Okay.
When you pull a camera back, zoom out and look at the chart, the source suggests you see a beautiful uptrend.
Defined by those macro factors you mentioned.
Exactly. Defined by those underlying macro tailwinds. And this is the crucial insight. Big money is interested in names that will easily outperform the metal itself when gold is rising steadily.
Right, the leverage effect.
Precisely. The strong macro backdrop allows these, best-of-breed gold companies to capture far greater profit leverage than just owning the commodity alone. That translates to potentially exponential share price gains.
Okay, I understand the theory, but let me just challenge the premise a little. If the decline was so sharp, that 6.4% day, doesn't that indicate the trend might be broken? Or that maybe institutional investors are getting spooked and heading for the exits?
That's a really fair question.
Yeah.
And it's what everyone worries about, right? But the research suggests the opposite is actually true here. The analysis specifically filters for names that have had sustained long-term institutional conviction, what they call a wall of inflows over time.
So they were already believers.
They were already believers, exactly. These sophisticated funds, they aren't likely getting shaken out by a single bad day or even a few bad days. They view this 6.43% drop as potentially a rare opportunity to scale into high-conviction names at better prices.
Ah, okay.
Precisely because the long-term thesis, rooted in those deficits and central bank buying, hasn't fundamentally changed in their view. So we are looking for names where big money has been along for the ride for a long while. That confirms the strength of the fundamentals before this recent pullback.
Okay, that reframes the entire conversation then. We're not just looking for bargains. We're looking for underlying institutional strength that can basically absorb temporary market shock.
That's the idea. Resilience backed by conviction.
All right, let's jump right into the first name the research flags as one of these oversold opportunities. Alamos Gold, ticker AGI. This is a pure gold producer known for, well, relentless accumulation by smart capital, according to this.
Yeah, Alamos is a perfect example of that growth leverage we talked about. What attracts institutional money are these extraordinary growth metrics. They show the companies capitalizing fully on the high gold price environment.
Okay, show me the numbers.
Look at the numbers that define this opportunity. Their 2024 sales clocked in at about $1.34 billion. Pretty solid. But that figure is expected to soar significantly to $1.9 billion in 2025. That's pure top-line expansion. Serious growth.
Okay, strong revenue ramp-up is great, but profit is really what drives the shares long-term, isn't it?
Exactly. And the net income projections where you see the real leverage. Net income was $284 million last year, 2024.
Okay.
And it is projected to almost double, soaring to $597 million in 2025.
Wow, nearly doubling profit.
Yeah. When institutional models project that kind of profit doubling in a single year, they often view the stock as fundamentally undervalued, even at its recent highs. So a dip like this, it looks like an invitation to them.
Well, it's no surprise then that AGI has easily outperformed the broader market this year. It was up 72.7% year to date before this recent turbulence.
Huge run.
The research also assigns it an overall MAP score of 74.1. Now, for you listening, if you aren't familiar with that proprietary research term, what does a score like that broadly indicate?
Yeah, good question. Think of the MAP score as basically a measure of institutional love combined with the underlying price trend strength.
Okay.
So a high score means that the fundamental strength, those massive profit projections we just discussed, is being consistently validated by actual significant buying activity from large investment funds. A score in the mid-70s like that, it ranks it as a top-tier gold miner, indicating serious, long-term institutional conviction.
Okay, that clarifies the type of conviction we're looking for. Now, having looked at the pure production growth of Alamos, let's pivot to a different but equally beloved model that institutional investors often rely on for maybe stability and capital efficiency.
Right. Let's shift gears to Franco-Nevada, ticker FNV. This one is a real bellwether in the precious metal space, but it operates on a fundamentally different model. It's a gold royalty play.
Can you just walk us through that model quickly? Because it's pretty critical to understanding why smart capital loves it, especially during volatile periods like this.
Absolutely. So traditional miners like Alamos, they physically dig the gold out of the ground, right? They bear all the operational risk, rising energy costs, labor issues, permits, regulations, all that stuff.
The hard part.
The hard, expensive part. Franco-Nevada, as a royalty and streaming company, doesn't actually mine the gold itself. Instead, they provide upfront capital, like financing, to the miners.
Okay.
And in exchange for that capital, they get a percentage of the future production or revenue from that mine, often at a very low fixed cost per ounce.
So they are essentially the bank that gets paid back in metal, not just cash.
Precisely. That's a great way to put it. And this model, it provides much greater insulation against rising operating costs and those operational snafus that miners face.
Right.
It means their growth is highly leveraged to the price of gold, but without the dilution of all those typical mining expenses.
Yeah.
And their expected growth is, well, explosive.
Okay.
2024 revenues were $1.11 billion. They are expected to soar 48% in 2025 to $1.65 billion.
Wow, nearly 50% revenue growth.
For a company with relatively fixed operating costs, like you said, that sounds like a recipe for serious profit leverage.
So what about the income side then?
That's where it gets even better. Their 2024 net income stood at $552 million. This year, 2025, it's expected to explode to $971 million.
So you see that near doubling of income again, just like with AGI.
Exactly. Very similar theme on profit growth. This shows that long-term institutional conviction that was powering the shares throughout 2025 before the pullback.
Now, F&B shares, they've gained 61.5% year to date, which is fantastic, but the recent market pressure definitely took a toll. The sources note that F&V is down about 15.8% from its recent highs.
Yeah, that's a noticeable drop.
Which apparently dropped its technical score down to 61.8%. That's a significant pullback from the highs. So, are those incredible 2025 forecasts already priced in? And is that pullback a genuine technical risk flag?
That's really the core question for big money, isn't it? Is the dip a risk or opportunity? The report's takeaway here is pretty firm. It pays to go with the flows.
Meaning the institutional flows.
Exactly. While the stock is technically pulled back, the institutional conviction, that underlying flow of capital into the name, historically signals that, in their view, the current weakness is likely a temporary dislocation.
Okay.
The institutional logic seems to be that while, sure, some of the growth is certainly priced in after that run, the severity of this recent drop provides a discount on a stock whose unique royalty structure offers superior risk mitigation compared to a pure producer.
Okay, so maybe a bit more of a defensive growth play within the sector.
You definitely see it that way. Less direct operational leverage, but potentially more stable margins.
All right, so if F&V represents stability, let's talk about just pure overwhelming execution. Our third oversold stock highlighted is Agnico Eagle Mines, ticker AEM. The report describes this company as having some of the best metrics you'll find in the gold space. High praise.
Yeah, AEM is often cited as like the outlier because of its demonstrated management quality and its sheer scale. They are leveraging their massive size to generate truly extraordinary profit growth.
Uh-huh.
And that's exactly what institutional investors look for when they're thinking about consolidating positions after a dip like this one. They want quality and execution.
Okay, let's see the scale we're talking about here. Give us the numbers for AEM.
All right. Their 2024 sales clocked in at $8.28 billion. Huge number.
Wow.
And they're estimated to ramp significantly to $11.39 billion in 2025. Massive top-line growth. But as with the others, the profit growth is what truly sets AEM apart in this analysis. Their 2024 net income stood at $1.89 billion.
Still a huge number.
Huge number. And it is expected to more than double, listen to this, to $3.89 billion this year.
More than doubling profit on an $8 billion base.
Yeah.
That's an extraordinary level of operational execution.
It really is. It speaks volumes about their management and assets.
It's no wonder the stock price reflects that kind of belief. AEM is up a staggering 109% in 2025 alone.
Incredible run.
And on a two-year basis, looking back further, it has more than tripled, gaining 231%.
Yeah. That sustained, massive performance is exactly why AEM was originally showcased as a top outlier stock in this particular research back in July.
Ah, so it's been on their radar for a while.
Oh, yeah. It has demonstrated a superior ability to convert high gold prices into net income. That shows the level of managerial control and capital allocation efficiency that these sophisticated funds demand. The institutional support here isn't speculative. It's seen as a confirmation of consistent, superior operational results over time.
Okay, so if we look across these three, Alamos Gold, AGI, the producer, Franco-Nevada, FNV, the royalty play, and Agnico Eagle Mines, AEM, the large-scale executor, what is the definitive unifying theme here? What connects these three names, regardless of their specific model, making them prime candidates for this institutional buy-the-dip action?
Yeah, the unifying thread is really the combination of two key factors. First, it's those extremely high growth projections for 2025 net income and revenue. We saw doubling or near doubling in income forecasts for all three names.
Right, that was the consistent pattern.
And second, this fundamental strength is paired with strong, historically verifiable institutional support. The smart capital, the big money, was building significant positions in these names before the recent volatility hit.
Okay, that's crucial.
It is. It confirms the long-term thesis is viewed as sound by them. These aren't just speculative recovery plays hoping for a bounce. They're seen as long-term conviction bets, where the recent drop offers a better entry point.
So what does this all mean for you, the listener, trying to navigate these massive swings in the gold sector and maybe decide where to deploy capital? The core strategic message from this research seems pretty clear.
Yeah, I think it is. The institutional strategy appears to be strategically scaling into these high-conviction names when the market gives you a discount. Don't panic out, maybe lean in.
Right.
Exactly. The source material is essentially telling us that as markets come under pressure, focusing on top-ranking names loved by institutions is the way to outperform. That's the claim.
Mm-hmm.
The strategy is about having foresight picking up on the biggest trends, like the ones powered by deficits and inflation early in their cycle, and sticking with the quality names through the bumps.
This research provides a fantastic snapshot of, well, potentially capitalizing on market dislocation if their thesis holds.
Yeah, the view is that pullbacks, especially when they happen against a powerful macro backdrop like the one described, offer a golden opportunity. Pun intended, I guess.
Mm-hmm. Yeah. Just make sure, as the research emphasizes, you're on the right side of the big money.
That's the key qualifier.
And here's where it gets really interesting, building on that conclusion for you to think about. Given the severity of that 6.43% decline on October 21st and this subsequent recommendation to buy the dip in these specific high conviction names, what does that necessary criteria make sure you're on the right side of the big money? What does that imply about future volatility?
Hmm, interesting question.
Does that institutional support simply mitigate the downside, or could it potentially invite more short-term pressure from traders betting against them?
Yeah, does it become a target?
Right. And critically, thinking about the drivers. What specific macroeconomic factors, those rising deficits, the sticky inflation, the central bank actions, what will you need to watch closely in the coming weeks and months to confirm the continuation of that beautiful uptrend into 2026?
Good question. Which one matters most?
Think about which macro indicator, if it were to suddenly reverse course, would potentially break the investment thesis for even these high growth miners. Something to definitely mull over. We'll see you next time for the next deep dive.